We're actually going to delve deep into the owner and operator relationships. The panel is going to explore the differences between contracts and some of the differences between global operators, regional operators, as well as the asset-light approach that invariably leads to management contract as opposed to the lease or participation in equity. So the panel today, I'd like to introduce our panelists. Here we have Andrew Rogers, who's CEO of Hospitality Property Fund, Wayne Trotman, who is with HTI Consulting, Guy Stellick, who is with Bond Hotels, CEO of Bond Hotels, and Nikki Foster with PwC Hospitality Practice. So welcome our panel today. Great. So I'd like to kind of start with Andrew. Andrew, can you tell us a little bit about HPF for those that don't know, and a little bit about some of the expansion plans that you're looking ahead with coming year?
Yeah, sure. Thanks, William. Hospitality Property Fund listed in 2006. It's a real estate investment trust. We've just recently converted from a property loan stock into a real estate investment trust as being the only specialized REIT on the stock exchange. 26 assets at the moment across the country. It's spread reasonably across the stock ratings from sort of luxury through to economy range of hotels. From an expansion plan, the cities that we've earmarked, we certainly believe in big boxes in major centers. We find that the economies of scale that they represent certainly are very attractive. So in terms of cities that we've earmarked and identified, if one takes Cape Town, the fund only invests in South Africa rather. So in Cape Town, we're looking in the CBD foreshore area. And in Johannesburg, we look at the Sandton and Rosebank nodes together with Pretoria, the eastern side of Pretoria, with Umhlanga in the Durban node. The fund has all of its properties are under lease, so essentially as a real estate investment trust, we're obliged to have our rental income through lease. So each of the assets are leased to various tenant entities, and those tenant entities either then engage through management contracts or, for that matter, on a franchise basis, different parties. So we represent a number of the brands in the room, probably the largest multi-brand owner of hotel properties in South Africa at the moment.
Perfect, thank you. Guy, let me ask the same question to you. Can you tell us a little bit about Bond Hotels and a little bit about your expansion plans?
Thanks, William. We've been using our time over the last year and a half or so to set up shop, and it's a proper startup. We own we've got 8 hotels within our portfolio. Including one Protea hotel, which obviously doesn't fit within Bond Hotels portfolio, but it's still under our ownership. We've got quite a unique approach to the way that we would go about managing and marketing our hotels. We've got a participative owner bill of rights, if you like. It's not the easiest thing in the world. It can go badly wrong if you don't set the expectations up front from the beginning. Our hotels are, as I said, they're owned under lease. We've got a couple of franchise agreements there as well. Our expansion approach is more into the corporate hotel market. Okay, so it's Cape Town, Joburg, the North Coast. It doesn't really include lodges at this particular point in time. It definitely does include West Africa, and it definitely includes the secondary and tertiary towns and cities throughout South Africa. So the opportunities that we're looking for are probably in the less sexy areas. So places like Saldanha Bay, for example, places like Umtata, places like Sasolburg, Secunda. We're particularly strong in the corporate and the conference market, in the domestic corporate and conference market. We've got great relationships there. But it's a very, very slow but steady approach. We don't take hotels that we don't believe that we can add value to. Okay, so it's there've been quite a few tears and quite a few handshakes to say, listen, sorry, I don't think we can work with you. I truly don't believe we can add value. And that's a little bit more about us.
Great, thanks, Guy. So Nikki, let me move down to the end. So can you tell us a little bit, as we're talking about expansion and about sort of globalization here in South Africa, what kind of trends are you seeing, and what kind of obstacles? How do you see the environment changing here in South Africa in terms of the owners that are here? And I guess put that in more in context, initially in South Africa and Africa, you just have a lot of high net worth individuals that rent hotels. Are you starting to see some of those inquiries and changes of that? Can you tell us a little bit about how the market's changing from an ownership side?
I think I think the market here in South Africa is actually quite an interesting one. And it doesn't necessarily fit perhaps along with your global model, because here we've got really very much a split between asset-intensive, asset-owning companies, many of which are local, they've grown up locally in South Africa, but you know, we're looking at portfolios of 50, 60 hotels. And then on the other side, we've obviously got the international brands that come in and invest in or manage hotels here. So South Africa's quite a unique situation in that respect. And I think what we're seeing is a continuation of both. You know, I do not see at this point in time South Africa going asset light. I see South Africa remaining a mix of asset light and asset intensive.
And sort of the same question, what are you seeing from your side, from your practice, in terms of that changing dynamic?
Yeah, I think if I can probably add a bit of value in terms of Africa, what we know probably best, especially over the last 10 or 12 years. I think in Africa we found, as you mentioned, I mean, typically I think there's two key trends in Africa that have happened over the last 10 years. The kind of investments that have happened, we've seen probably about 80–90% of our clients come from the country of origin. So we're not seeing a lot of investment flows coming in to Africa, or we haven't seen to date over the last 10 or 12 years, although that is changing. And we've also seen that typically about 80–90% of our clients are also first-time hotel owners. And so they're coming in from their conglomerates, or they are high net worth individuals, as mentioned. And so they are investing purely in the asset and typically adopting an asset light, contributing to that asset light strategy by bringing in companies on management contracts. We're also seeing, from a South African perspective, we're looking at property companies. The model is slightly different, because if you look at property investment companies, they typically don't want to get involved in the ownership of a hotel. They're typically looking for leases. And they're trying to adopt this model into Africa, which is being difficult to sort of replicate. There's only one or two companies that would actually look at leases. So the property investment companies that are moving into Africa, that are developers, like sort of Atterbury and Resilient and a number of others, and also sort of private equity investors, are typically looking for more of a lease model, and they're also looking at selling off the land. So, but what we are starting to see in the last 2 to 3 years is now we're starting to see those owners that started getting into hotels and seeing it lucrative, especially in some cases sort of frontier markets, or markets where there's significant opportunities. They're now looking at either a regional strategy, or they're looking at a multi-property strategy. And we're starting to see those flows changing, and the kind of owners and their capabilities changing, and the size of projects, and also moving from individual standalone projects to mixed-use type, more ambitious type projects. So pretty exciting what's been happening in the last sort of 3 to 5 years, and we're starting to see that change. We're also trying to look at, to bring in these other property companies, and to bring them in, we're having to be quite creative in terms of trying to create hybrid type models, mixed between fixed variable leases and management contracts, or having management contracts, but building in a fair amount of financial security for the owners in terms of owners' priorities and various different other structures that provide some kind of comfort in the event of poor performance.
Great, thank you. So this next question is going to be for all 4 of you on the panel, because in each of your capacities, you're all involved in this in one way or the other. So what do you think are the major, and I'll start back here with Andrew again, and we'll just go right down the panel. What do you think are the most negotiated issues in your management agreements that you're experiencing, and why? What issues seem to kind of slow down that process of management agreement negotiation?
I suppose the key issues is that of, let's start with it. If it was a potential new build, would probably be key money. I suppose one would look to have some sort of a contribution, if you like, from, I suppose, from an operator. Very little risk generally taken by the operators as such. I suppose, if one looks at the contribution towards the new development, it's really to sort of achieve the desired yield if it is a new build. But generally, the existing site, it's the length of contract, the contribution to capital investments, whether it be an FF&E or reserve account. That said, also, some of the issues are quite contentious are over staffing matters. Key staff and what key staff you're looking to sanction and support, if you like, in terms of the recommendations made by the operators. Because generally the view is you like to have a local person represented at senior management level or financial level, that is. And then also, I suppose, the fees in terms of that, and one of the things that we like to have is a bit of a risk and reward contribution from the operator. So essentially allow the operator to have a sliding scale on his, what we would typically call incentive fee basis. So essentially, I suppose, if your benchmarks at sort of 8 or 9% of AGOP or EBITDA, depending on what the various term is, you'd like to have the ability to ramp it up if they perform well, and similarly, if they don't perform well, also take a bit of a hit there too. But again, I keep coming back to the fact that it's very few times that we've seen brands putting investments into hotel real estate. The media seem to get it wrong. Even the minister this morning still misunderstands a lot of the transactions. Where certain international brands are building hotels. They're not building any hotels. It's developers that are taking the risk in building it. It's generally funded with, I suppose, development corporation or bank funding. Challenge in the market at the moment is that to find, institutions that haven't got scar tissue from the hangover of the World Cup, where a lot of the hotel projects didn't succeed. And we're slowly coming out of that period, and I think one needs to be very mindful that this is a very fragile market. One of the challenges I think of the African investment model is a lot of those African cities are quite small markets rather. So the first parties that are in there are going to do very well. The challenge is, I think, when those infrastructure projects are completed, we just have to see what happens with terrorism and the geopolitical instability in those markets and how quickly they can turn down. We in our own markets see that in our secondary centres. Unlike Guy, we're trying to exit some of our assets in secondary centres for the simple reason that whilst they're good businesses and they trade profitably, they're the quickest to turn down when the market softens and they're the last to pick up when the market picks up. So our model, if we talk about some of the challenges, I suppose, is to try and get the operators to inject some of their own monies into the project to share the risk, if you like, with us as owners in the hotel real estate.
Thank you. Wayne, what are you seeing on your side?
I think it's the same thing. It's important also to understand, when we enter into a negotiation process with an operator, to understand first from the client's perspective, what is important to them, because as with any negotiation, there's going to be some give and take. So it depends on what is important to the owner. The owner's key objective is to mitigate risk, and you're going to be focusing typically on fee structures, or if they're looking at maximizing profitability, you might look at a higher incentive fee structure and a lower base fee structure. If you're looking at mitigating some of that financial risk, you can look at different mechanisms that you can try and push for in terms of things like, as Andrew mentioned, in terms of key money. The others is sort of a operating type guarantee, or owner's priority return, or threshold on GOP, where you get a wavering of incentive fees. So these are different ways, and in many cases, actually, the operator is not physically putting in money, but it is more loss of fees, or from that perspective. So and these things you've got to evaluate, and you've got to look at what is important. There's other components that owners are important to some owners in terms of owners' control, in terms of how much involvement they have and what flexibility from that perspective. But I think the key trends that we've seen more so is trying to build in some more sort of risk-taking mechanisms to make the contracts a bit more balanced from an ownership perspective, and also rewarding. A good contract is something that's it's equitable, it's sustainable, and you're talking a long-term agreement, 20 to 25 years. So you've got to look at something that's going to be able to be sustainable, and go through the sort of ups and downs. So those are the kind of mechanisms that you want to be able to build in. Because it's no use having a one-sided contract, even if it's one-sided from from the owner's perspective or one side from the operator's perspective, at some stage there's going to be a breakdown on that relationship. And once that trust is gone, you're not going to be able to recover from that relationship.
Great, thank you. So Guy, from the operator side, what gives you the biggest headaches in your management contract negotiations?
Well, I think, you know, one has to look at what's taken place in this country over the last 30, 40 years from a management contract point of view. You know, 30 years ago, you know, certainly Protea in those days were pioneering the management concept, the management agreement concept. And, you know, it's come a long way since then. But I think what worries me as a hotel owner and an operator is the fact that there are very few management contracts actually up for grabs in this country. And you know, I don't want to be controversial or anything, but I think there's certain legacy issues there in terms of the way that hotel owners allowed themselves to be locked into very, very one-sided management contracts that didn't have any performance from the operator in many, many cases. So when we started Bond Hotels, I mean, that was the first thing that I couldn't get my head around. I couldn't get my head around the fact that I could have the audacity to go and approach a hotel owner and say to them, listen, we'd like to manage your hotel, but I'm not expecting you to throw any performance targets into the contract. I know that because I would want that in my own hotel management contract. So, you know, first of all, there are, and just kind of veering off a little bit there, I think, you know, there's so many hotel owners in this country that have been burnt by defunct management companies that don't exist today. And I'm not talking about the big boys, and I'm not talking about the guys that are in this room. But there have been so many burnt hotel owners that it's, in many, many cases, these guys are running the hotels themselves, okay? In most cases, running them into the ground. I hate to generalize, but it's true. And secondly, they've got a very, very poor image of hotel management companies. So to try and resurrect a hotel management contract in an environment where it's under siege is very challenging. And if one has to differentiate between what's happening in South Africa and what's happening in Africa, we have a reasonably mature hotel management agreements environment in this country. There are far more management opportunities in Africa, okay, West Africa.